Thanks for joining me today. Volatility is the rate at which the price of a stock rises or reduces over a certain period of time. Greater stock price volatility often means greater risk and helps an investor to value the variations that may happen in the future. So, it is a gauge of how much the stock market's total value varies up and down. Beyond the market, individual stocks can also be deemed as volatile. More precisely, one can evaluate volatility by seeing at how much an asset's price differs from its average price. Standard variation is the statistical measure that is mostly used to represent volatility. Stock market instability can raise when the external events create vagueness. Certain stocks are more unpredictable than others. It's believed there might not be a big swing to the stocks of a blue chip company, but stocks of a high-flying tech may make huge price swings, which means blue chip stock has minimal volatility, while as tech stock has higher volatility. An individual stock could also become more volatile during key events like quarterly revenue reports. Volatility is generally related with fear, which tends to increase amid bear markets, stock market failures, and other huge sinking moves. However, volatility doesn't gauge direction. It's just a gauge of how huge the price fluctuations are. So you can assume volatility has a gauge of short-term vagueness. Now let's talk about the detail around what drives stock price volatility. First comes the political and economic factors. Governments play an integral role in regulation of industries, which can affect an economy while making decisions on trade, contracts, legislation and strategy. From speeches to elections, every single thing could cause boomerangs among the investors, which would impact stock prices. While, as speaking about the economic factor, economic data also plays an integral role. When the economy is in a good state, investors tend to respond positively. Employment reports, inflation, stats, consumer spending numbers, and quarterly GDP calculations can influence the functioning of the market. Second comes industry and sector factors. Certain events could cause volatility in a specific industry and sector. For example, in the oil industry, a key climate event in a crucial oil-producing area can lead to soaring of oil prices. Another example could be how oil prices are soaring due to the Western countries' sanctions on Russian oil. So, in conclusion, the share price of oil supplying companies may rise. On the other hand, additional government directive in a particular industry would result in stock prices falling due to intensified compliance and worker costs, which might affect upcoming earnings growth. Coming up, the factor that can drive stock price volatility is company performance. Volatility isn't all the time market-wide. Sometimes it can correlate to an individual company. Positive news is, such as robust earnings or a latest product that is exciting consumers, could make investors think well about the business. If in case the ample number of investors consider buying it automatically, it would lead to increase in demand, which in turn will lead to increase in the stock price. The positive or negative performance could also lead to effect on larger market, depending upon how big the company is, of course. And lastly, how can we measure stock market volatility? Well, it's the basic variation of a share's annualized yields for a certain period and indicates the scale in which its price may rise or fall. It's believed that in case the value of a share swings quickly in a brief period, reaching fresh highs and lows, it's said to be highly volatile. But if the share price moves up or down much slower or remains comparatively stable, it's said to have low volatility. Historic volatility is measured utilising a couple of past market rates, while as implied volatility sees as likely future volatility using the market value of a market traded value derived from an underlying variable asset as an option. I hope this has helped you out today. If you want more info, check out the website kalkinemedia.com. And I'm Rose Jacobs. I'll see you again next time.